Equities are pressing deeper into record territory even as inflation surprises and long bond yields break above 5%, forcing markets to choose between an AI-fueled boom and a valuation hit from higher rates. This is vTalkInsight, Equity Pulse Daily for May 15, 2026, where we unpack how that tension is reshaping risk and return across global equities. The macro story starts with inflation refusing to back down just as equities make new highs. U.S. producer prices surprised sharply to the upside, with headline PPI running around 6% and core above 5%, signaling that companies face sustained cost pressure likely to feed into consumer prices over the next few months. At the same time, growth data still look resilient on the surface, which complicates the policy trade-off. Retail sales have risen for 3 consecutive months and jobless claims sit near 200,000, yet gasoline-driven price increases and a recent drop in real wages are eroding purchasing power, especially for lower-income households. Bond markets have responded decisively to this mix. 10-year Treasury yields have pushed above 4.49% and are testing the 4.5% area that many see as a critical line for equities, while the latest 30-year auction cleared with a 5% coupon for the first time since 2007, but with lackluster demand. Fed funds pricing has moved from debating cuts to contemplating further hikes, echoing comments from policymakers who now show less tolerance for additional supply shocks after years of above-target inflation. Against that backdrop, the narrow confirmation of Kevin Warsh as Fed chair raises fresh questions about central bank independence just as political pressure for easier policy is rising, but current data leave little fundamental case for near-term rate cuts. For equities, this reinforces a higher-for-longer regime in which long-end yields grind higher over several years, eventually weighing on capital expenditure and multiples. With S&P 500 price-to-earnings ratios already at the upper end of historical ranges and forward earnings growth expected to slow toward 10 to 11% annually, future equity returns look increasingly dependent on sustained profit expansion rather than further valuation uplift, while 5% bond yields offer a credible alternative. The inflation story cannot be separated from geopolitics, and the Middle East is once again center stage. Tensions around the Strait of Hormuz have escalated, with commercial vessels seized, attacks on tankers, and the risk of partial closure disrupting key oil and petrochemical routes at the same time as the Revolutionary Guard appears to drive Iranian policy. Those disruptions have flipped the petrochemical industry from trough to peak pricing within weeks, even though end demand for essential products has barely changed. Even a rapid reopening would not normalize supply chains quickly, with some estimates suggesting as long as 275 days to fully unwind the logistical snarls and ship repositioning now underway. For central banks, that combination of higher energy costs and only modestly cooling growth looks uncomfortably like stagflation risk. The Federal Reserve is described as constrained by energy-driven inflation on one side and a gradually weakening labor market on the other, while some estimates put the probability of a broader market meltdown tied to conflict and recession at roughly 1/3. Layered onto this is a more adversarial global landscape. China has delivered its strongest rhetoric in years on Taiwan, invoking the risk of great power conflict even as both sides pursue managed strategic competition with selective cooperation, and in the UK, gilt yields and spreads over treasuries have widened as investors price political uncertainty and inflation risk into long-dated bonds. Energy transition dynamics partly offset and partly rewire these risks. Europe's rapid build-out of renewables, highlighted by Spain's solar surge, has helped insulate some power markets from oil shocks, but a projected quadrupling of data center capacity and the need for 60 to 70% faster renewable additions mean power prices and infrastructure spending will remain central to the equity narrative. Against that challenging macro and geopolitical backdrop, equity leadership remains firmly in the hands of technology and AI. U.S. stocks, particularly the S&P and Nasdaq, are setting record highs, with gains overwhelmingly driven by large tech and semiconductor names while most other sectors and regions contribute little to headline performance. Strong earnings, rising guidance, and ongoing capital expenditure from major technology firms are the core support for this rally. AI hardware demand is outstripping supply, with Nvidia projecting roughly $1 trillion of demand over the next 6 to 8 quarters. Memory and chip supply chains in Korea and Taiwan logging powerful earnings growth, and a growing share of S&P companies now quantifying tangible AI productivity gains rather than just talking about potential. Company signals underline how AI is spilling into broader infrastructure. Cisco delivered a standout quarter, with product orders up more than 30% and networking orders above 50%, driven by $9 billion of hyperscaler AI-related demand, an upgraded revenue target, and a strategic pivot that channels resources towards silicon, optics, AI, and security, sending the stock up more than 16% and reinforcing the data center build-out theme. Ford is reshaping its own narrative by targeting grid-scale battery storage for hyperscalers, with potential deals that could unlock around $10 billion in growth and repurpose existing electric vehicle battery plants. A licensing agreement with Chinese battery leader CATL gives Ford a cost and technology edge as demand for large-scale storage is expected to roughly double by the end of the decade, effectively turning an automaker into an AI infrastructure and energy transition story. Capital markets are echoing the same theme. Cerebras' IPO has been heavily oversubscribed, with its valuation jumping from single-digit billions toward tens of billions in a matter of months, while talk of future listings for SpaceX, OpenAI, and Anthropic, and a potential $900 billion private valuation for Anthropic, all point to intense appetite for AI exposure, but also raise questions about liquidity capacity and fundamentals. Yet the AI complex is far from risk-free. Semiconductor indices are up around 50% in just 2 months. Some AI and chip names would need a 20% pullback merely to revisit their 50-day moving averages. Volatility and ETF volumes are spiking, and application software stocks are already down about 40% as markets reprice business models most vulnerable to AI-driven creative destruction. On top of valuations, concentration is a clear fault line. Tech and AI-related stocks are masking broader market softness. QQQ remains the dominant vehicle for large-cap growth exposure with enormous options activity, and rising consumer electricity bills are fueling local pushback against new data centers, creating regulatory and power supply constraints that could cap growth for cloud providers like Amazon and Google even if end demand remains strong. Flow data and investor behavior confirm that the current phase is still risk-on, but with important nuances. Market participants are leaning into AI and strong first-quarter earnings. ETF volatility is elevated, and Invesco reported about $20 billion of net new flows in April and $150 billion over the past 18 months, while investing heavily behind QQQ as the flagship large-cap growth vehicle. In financials, there is a clear split between large transaction-driven banks and smaller lenders reliant on spread income. Institutions like Goldman Sachs and Morgan Stanley are seen as better positioned than regional banks in a curve environment that now prices a higher chance of another hike, while tightening consumer lending standards and rising use of payday and pawn credit among lower and middle-income households point to growing stress beneath still decent headline retail sales. Company results in consumer and luxury highlight that divergence. Starbucks is seeing a turnaround in North America with improving margins and steady coffee demand, whereas Burberry delivered a sales beat but guided cautiously, citing geopolitical and economic uncertainty, even as China sales grew about 10% and strategic challenges in moving further upmarket remain unresolved. In aviation, Boeing shares slipped despite China agreeing to buy 200 planes, as expectations had been set for a larger order, underscoring how sentiment around China-related demand remains fragile. By contrast, emerging market equities show stronger earnings momentum, with growth above 40% and relatively undemanding valuations, helped by AI-driven gains in EM technology, while a rising share of investors and retirement plans are exploring private equity and private credit as complements to public markets, despite liquidity and fee hurdles. Pulling these threads together, the equity backdrop is one of strong risk appetite and powerful AI and energy transition themes, offset by higher for longer rates, geopolitical fault lines, and a narrowing earnings base. The key signals from here will be how far 10-year yields press toward 4.75 or 5%, whether energy disruptions intensify, how deep the AI IPO calendar becomes, and whether consumer and credit data start to erode today's concentrated earnings strength. To wrap up, global equities are being pulled between a persistent inflation and yield shock on one side and an extraordinary AI-driven earnings cycle on the other. Record index levels sit alongside long yields above 5%, Middle East and Taiwan tensions, and a rally that is increasingly concentrated in a handful of U.S. tech and semiconductor names, even as companies like Cisco, Ford, Starbucks, Burberry, Boeing and Invesco reveal how uneven the underlying landscape has become. From here, the balance of risk hinges on whether AI and energy transition capex can keep delivering strong profits as policy stays tight, energy remains volatile, and consumer and credit conditions gradually bite. Watch the 10-year yield, oil and shipping flows, AI infrastructure announcements, the IPO calendar, and high-frequency consumer data for the next inflection in leadership and volatility. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.